Good afternoon, everyone. Brett Crowther with you today, talking about short verticals once again, and we have a lot to cover in today's session. There's some interesting things that happened about with one of the paper trades that we had on, and I want to use that as an educational experience on what not to do. All right, this can help us save money and really understanding managing those trades. And so very important. We always think about getting in, but sometimes getting out, getting out is just as important. I mean, there's three really important topics: getting in, getting out, and how much you're risking. It's like a three-legged stool. We'll cover that. We're going to look at the market. We're going to look at some other potential paper trades in this session. So stick around with me. We got a lot to discuss. I want to give a shout out to Cameron May, my good friend out there handling the chat. Thank you, Cameron. Ricebird, Speaker Greg, Kelly, Jimmy, there's so many in there. Welcome, everyone. Welcome aboard. Thank you for joining me today. So we're going to get right into it. But first, give me about 20 seconds here. Let's cover some disclosures. Do remember that what we talk about today, well, actually, let me start with options. Do carry a very high level of risk and are not suitable for all investors. The information here is for educational purposes only and should not be considered a recommendation. Paper money trades are for educational purposes only. Short options can be assigned at any time, regardless of whether they're in or out of the money. Investing does involve risk, including the loss of principal, and also past performance is no guarantee of future results. And then here's your option Greeks definition of that. Do note that if we do use a stop loss order, that once it is activated, it can fill at a different spot than where you placed it. So be aware, it may not fill exactly the same spot you would hope for. So be aware of that. Okay. So with that said, let's go ahead and we're going to jump out to the overall market and take a look at what's going on out there. And it looks like the market's pulling back just a little bit. So this is where we got to think, okay, what's going on here in the market, right? What we saw is it was sideways, and we talked about this a lot in the class as is going sideways. Let's kind of expand this to get a little bit better feel of it. And then as it's bouncing back and forth throughout this channel, it finally broke through the channel, came back, retested it as resistance, and then rolled over and dropped down. Now, it did have some prior support that broke through that, which really opened the door for some potential downward action. And that came more of a, okay, look out, we could head lower. But then right after that, and this is where the geopolitical issues came in, and we talked about this in the class even last week, just how this, some of those geopolitical announcements are very similar to just like a earnings announcement on a stock, right? It can just take wherever it is and shake it up, and then it just goes in a different direction just because, just because this came out, nothing necessarily fundamentally changed, but just because the outlook, the future expectations possibly had a major shift, then the stock, or in this case, the market reverses direction. And that's what we saw, even until we had a gap right here, and then off it went to the races, just climbing hard into all-time new territory, right? And so, well, what do we do with this? Now, notice that the RSI went into the upper reversal zone. Be careful about thinking that because it's in the upper reversal zone, that means it has to drop down. It has to, continue or go over and roll over and go lower. I mean, if we look at it on the downside, sometimes that first peak, or should I say dip into the downside isn't, exactly where it turns around. Sometimes it's a second or third. We did get one here. This could even be a second here. But the point is that it doesn't mean it has to fall apart. And sometimes it can even come down and bounce. Let's see if we have some in here. Yeah, like here's some right in here where price action came, rallied on up, but it's just some pullbacks. Let's get this so we can see it. Some pullbacks in the overall upward trend. And what do we see? What pulled back down to the 50%, rallied up, somewhere in that ballpark, about that 50%, rallied up, and it went back into the upper reversal zone. And so one mistake that I often see some traders make, some technicians, is thinking, oh, upper reversal zone implies reversal, therefore it has to drop, and that's not necessarily the case. Now, it would be surprising to see some profit taking, some sort of a, it's been a good run, the legs are weary, you may want to take a little bit of a breather, and that's not surprising. So keep an eye on that. But then if it does, where might we expect it to pull back to, right? Is really the question. Well, there's the obvious spot, which is right here, the old resistance. All along here was resistance. Now it broke through it, and so that could be a potential support level. If it breaks through that, then the next thing I do is look for a Fibonacci, right? So I'm going to come down, grab our Fibonacci tools, and I'm going to draw it from this low here up to that high, and give us some area. And remember, this is kind of the area that we'd expect some sort of support to come in. And so I'll just draw a box in here so we can see this right about there. That's the area that we'd expect it to find some support. You know, either it bounces around the 38, the 50, or the 61. Typically speaking, the 50 tends to be one of the stronger ones. It doesn't necessarily line up. The 50 doesn't necessarily line up. It'd be nice. Oftentimes I'll see it line up with the old support, you know, somewhere in there, and it kind of gives it like this extra edge. But we don't see that in this case. But that's still, if I can remove these now, this is kind of the ballpark that we're looking at, somewhere between the 66.50 all the way up to the 68.50, we'll say. So about a 300-point range in there. And so keep an eye on that and see where that bounces. But overall, so far bullish, maybe a slight pullback, and then, you know, but overall, still a bullish posture. All right. Now, I look at the bullish. Why do we look at the posture? And really, it's to get a gauge as to what the overall push is. And so, you know, I do a lot of cycling, and one of the things about cycling is I can go any direction I want, right? North, east, south, or west. But if the wind is coming out of the north, it's difficult to go north. It's easier to go south when the wind is going south, or it's easier to go north when the wind is going north. The point is, it's easier to go a direction when you got a tailwind instead of a headwind, right? And oftentimes these stock positions are like that, meaning they can go against the overall market, but when we have the overall market kind of going that same direction, it just helps push it in the direction that we want it to go. And so that's why we look at the overall market and try to get a gauge on, okay, what's the big picture here? Now, with that said, yes, oh, thank you, Cameron, for reminding me. Follow us on X. You know, if you're not on X, follow us on X. You know, my X handle is Brett Crowther. CS, and Cameron Mays is Cameron May CS. But please take a moment, go out to X, give us a follow. We post things, follow-ups, different events, news announcements, and stuff to keep connecting with you between the weeks. In fact, where's Richard Judge? Had a comment on him. He's got a good beard. I was trying to grow a beard, but I can't look as good as him. So, right, let's see. Credit spreads. I trade over 300 contracts a week, 9% average. Okay. Good, good. All right, well, let's do this now. So here's what I want to do. I want to talk about some of our paper trades. Now, we set some last week. Some of them didn't take. We do have two of them that are going on right now, MRK and CRM. And I want to look at both of those and walk through some very interesting concepts. And I want to get into the weeds about what is going on in this, okay? So if we go over to the monitor tab, if we look at, let's handle MRK first. And MRK, this is killing me. What, for those of you in my class who show up week to week to week, what do we typically see happen to our paper trades on a Thursday? Want to help me out here? Wait, answering, pull this up. There's always a delay between what I say and when you hear it. Let's see. So we still have a little bit of time on this one. It's going to expire. When do we have this? 4/29. Oh, we're getting close. We're about a week out. So yeah, they melt down. Thank you, Ron. They sink, Scott. Hey, Mickey, how you doing? Yeah, for whatever reason, I need to teach this class on Wednesday. I got to see if I can move this or something because these Thursdays have just been awful for positions. And here's the most frustrating part as an instructor. In fact, when I pulled up the other trade, that CRM, I was so upset. And I'll show you why. But then I thought, no, no, no. Let's change this into a teaching opportunity. Let's make sure we understand this. Well, so last week we were somewhere in here, this ballpark. It had time to come back, and it was coming back, and then it died. It's starting to rally a little bit. We still have a little bit of time on that, but not a lot more. This one is going to expire the first of May, and so we have a little bit of time. I'm going to let that one hang and just try to catch it when it bounces back a little bit more. But really, CRM is the one I really want to focus on. So CRM is kind of an interesting one. Look at this profit loss day, $245. Now let me back up and explain what we had on this one on CRM. CRM was actually, if you recall, an iron condor. I was illustrating how to do a short call spread and a short put spread. And so we did a short, let's zoom in on this so we can see this. Come on, come on. I don't know about you, but my eyes are not what they used to be when I was in my 20s, and so we need a little bit more real estate on this, right? So what happened is right here, we looked to get in and I said, okay, let's sell a short call spread. And we did it up here, so it was actually right in this area. So we did a 175, 170, and then we did a short put spread. So really, we had these two trades. We needed it to be below this line or above that line at expiration. And if it did both those, we'd make the max gain on both trades, right? Well, what happened is it dropped down. And so when it dropped down, that call size, ride this out to expiration. It looks like it's good. It's out of the money. I mean, we're talking about the stock price was like 190. We have our strikes down here at what, 175? Yeah. Yeah, we should be okay, right? And we're 2 days till expiration. And then what happened? Whammo. So, yesterday it was up quite a bit. It wasn't quite max gain, but I could have closed it out for a pretty good profit on that. And I was actually clicking on it to actually take the profit. I thought, no, 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 no. Let's wait and do it tomorrow in the class. And so I think this goes to show several things. One of them is when we have a situation where we're in a profitable position, should we give it just that one more day, one more day, one more day? Well, it depends. In this case, no, we shouldn't have. We shouldn't have. Why? Because it was too close to expiration and a lot of the gain was already there. And so why not take it off the table? There's just too little of reward left to a huge amount of risk with really no time to recover. And this is a perfect example of that, okay? Hey, were we back? Are we back? Did the CRM kill the stream for a second? Well, it looks like we're back. Oh, okay. Looks like we lost about a couple seconds. Okay. So I was just saying, though, that basically, it was in a profitable position. It took a hit. So let's turn this into a learning situation, okay? And what I want to do is I want to actually walk through some of the nuts and bolts on this trade here, which I think are really interesting. Because if we go in and look at the trade itself, let's put CRM here. So here's the position that we have. This is the 175 and this is the 170. So it's these two lines right here. Again, we sold the 175, expecting the stock to be above 175. And then we bought the 170 as a protection in case it goes down, right? Looking forward to, and it was above 175 until yesterday, but now this is in the money. And here's what I want to talk about is look at what happens with like our deltas. Look at how these deltas they start to get some wide spreads. And I want to explain something about this because as we get close to expiration, sometimes I've seen people even get into short verticals closer to expiration, looking at the delta, thinking, okay, if I like, for instance, if I were looking to get into a trade today, I'm just using this as a crazy for instance, at 165 with a 20 delta, if we're using that as a proxy, for approximation of potentially being out or in the money, this would say that, the approximate probability of being in the money is 20%, or vice versa on that is 80% probability of being out of the money. And so my point is when we're looking at something saying, hey, it's 80% probability of being out of the money, we tend to feel very secure about that, right? Because that's the general probability. Well, that's not necessarily the case when you get close to expiration. So look at this. First off, let's look at what happens to these deltas. Let's take a look at the 165 has a delta of 12. So that would indicate a very little probability of being in the money. If we go down here, now this is looking at the May 22nd instead of the April 24th, so expire in 1 day. These expire in 29 days. But if we look at the 165 there, well, what's the delta there? The delta is 34, right? And so if we're comparing, let's see, where's our drawing tools? Where'd they go? Did they disappear on me? No, here they are. Let's grab these. Just a second. Let me grab. I wanna highlight this. So let's do this. So did I get the box? I think I did. 165. So right there, we got it. 12 cents there, and on this one we have the 34-cent delta. And so what's the difference? Why is 112 and one's 34 cents when they're both 165? Well, this goes to show that it's taking a consideration that time, right? This one, it's expiring tomorrow. So what's the probability of, the stock, or in this case, dropping down to 165, where the other one, what's the probability of that? Well, it has more time, obviously, to drop down to the 165 in the May timeframe. And so the probability change on that because of the time difference. All right. Now, here's something I want to also express. We have to know it's really good to know what happens to these deltas as we get closer to expiration. So as you'll see, this one's 12 and this one's 34, right? And if we do the same thing, like let's look at the let's look at the 180. This would probably be a better example. The 180. The 180 has a delta of 89, but down here the 180 has a delta of 58. Quite a big difference, right? Now, again, why is that the case? Well, because there's a lot more time, and so this can actually have time to move, where this one really, the likelihood of the stock, jumping up to 180 is less likely in a day. But so what happens? Well, these deltas are separating. What's going to happen to these deltas when it expires? Does anyone know? There's one or two things. The out of the money, the delta needs to go to 0. The in the money, the delta needs to go to 1. And that's true for all the strikes, all right? For all the strikes. And so anything out of the money going to 0. So it has to move down to 0. And then anything in the money has to move up. And so this is where we can get some kind of these fake delta readings in a sense where especially the at the money has to change. They have to start spreading out. But then what does that mean if the stock moves? Like if the stock moves right now, well, right now we're kind of right in between the 170 and we're at around 172.50. So this is maybe a good example where it's really close to this one. So this one right now is out of the money, right? But if it dropped down, it could very quickly become in the money. And so it's not going to take much for that delta to go from like a 47 to like a 50, 60, 70. And what's going to happen is that gamma, and this is what they call gamma risk, that gamma has to get really big to make quick moves on the delta. And that gamma can get huge. Right now, it's not quite as big. You can look at the gamma here relative to the later one. It is quite big, right? Like we have 2 cents here, and these are like 4, 5, 6, 7. And it's bigger in the middle because this has to make a bigger adjustment as it goes to 1 or to 0, where these are already, this is almost at 0, so it doesn't need a very big adjustment, or this is almost at 1. So again, it doesn't need a very big adjustment. But let me bring up another one, another stock though, and I think this will help drive this point home. Like maybe I bring up Halliburton would be a good example. Okay, look at the gammas here. Look at the gammas. 32. 32. And so this is again an example where maybe this one 27 for this 39.50. So again, people would look at that and say, yeah, that's pretty solid. So if I were looking at this thinking, hey, I'm in a pretty good shape, the probability of this one becoming in the money is only 27%. Therefore, I have what, a 63% probability using that as a guideline. It's going to be out of the money. Well, if the stock moves $1, that 27 is we're going to add that 27 if it goes against us, and that's going to give us what, 54? All of a sudden, $1 move, it went from 27 to 54. Boom. That's gamma risk, folks. And so that's what's happening to the Greeks that are throwing it off. And so you got to be very careful about just following the probabilities with the Greeks all the way into expiration. I'm feeling very solid with that. Okay. All right. Comment comes in, hey, use expectancy. I could use expectancy plus or minus. It's essentially the same thing. But I wanted to leave this up, and that's a great question, Ron, but I wanted to leave this up to illustrate how the Greeks change and how the Greeks can, at times, give kind of this false sense of, hey, security, thinking, okay, we're good, right? And then whammo, they can change dramatically. And I think this is a great example, a great teaching point. What would the ATR give us on how much it might move a day? Let's check it. Let's check it. I'm gonna add the ATR real quick. I'll have to go back, not to Halliburton, but we'll do this. Average true range, add that, apply, okay, and then let's go back to CRM. Let's see what we have for an ATR. ATR is sitting about, what is that, $8? Around $8 is what the move could be. But see, here's the deal. So $8, it was up around 191, $8 a day. I mean, yeah, could it get down to 175 is what we're thinking, but you're like, well, it's still $16 away. We should have been safe. You see what I'm saying? We should have been safe, right? And that's a typical day, but it didn't. It was more than a typical day, and it happened to happen. Well, it happened to happen right at our expiration. So wham, we got hit on that one. Um, what was another one? UAL. I think UAL was another one they had or not. UAL. Let me check out STZ. Oh, here's another thing I wanted to show on this one. Okay. So, and this is another issue that comes up that why we might want to close out those trades closer. If we're thinking about closing it out, it's sometimes good to close it out maybe about a week before expiration, not waiting to the last moment. All right. So I wanted to bring up STZ to illustrate this concept. So follow along with me here. If we're looking at these Mays, now these bid ask, aren't really tight. I mean, we got the 165 is 740 versus 880, and so they're kind of wide, right? We got a dollar 40 in there at the 165. But let's look at the 165 here. A dollar 40. What's this one? Wait, 240? 240? That's a lot bigger, right? Um, what do we have? That doesn't have a 162.50. We got a 160. We probably have a 160 here. Well, now we're getting kind of smaller numbers, but what will happen is notice how the bid-ask spread is really wide here compared to here. Now, why is that the case? Why is that the case? Well, that's the case because a lot of traders are kind of closing up. They're kind of done with that. They're moving on to the next expiration cycle, and so there's not a lot of activity, going on that. And as such, the market maker needs to balance out all the buys and the sells. And if there's more on one side than the other, they have to widen that bid-ask spread to get their, cover their risk as they maybe take on more of one side or too many of the other side, right? So that's what's happening. The spread amounts are widening because the volume is dropping. It's kind of winding down. And that's another thing that can catch people where they think, oh, here, I'll just, get out a day before or something, then go to find out. But there's not a lot of liquidity. It's very illiquid and they just can't get out at a price that they thought they could get out. Maybe they got in on a stock with really tight bid-ask spreads. Maybe it was like 20 cents wide. And then they go in there and they find out, oh, wait, now it's $1.60 wide, and they're thinking, wait, that kind of kills my entire trade. So these are things to learn. These are things to be on top of. And hopefully you can use this experience that we had in this class as I was saving it for you for today to learn from. So you're welcome. You know, oh my goodness, crazy, crazy, crazy. All right. So now we're also, by the way, any questions on this? Let me just make sure I got everything. It was a good trade for me, Brett. Closed the short call vertical at 90% profit, short put vertical 80%. Yeah, you were probably looking at it earlier this week, huh, Susan? Well, good, good. I'm glad you were able to do that. Let's see. Why do you have a call at 200, 205? So back on that one, let me grab my this. We had, let's go back CRM. So it was a call set because we did an iron condor. We did two verticals. We did a short vertical, a short call vertical here, and a short put vertical there. And at the time, price was is like right in the middle. It was right about here, right? It was kind of like right there. And so we did a short call as just illustrating how we can do both of them on one trade. And I use that kind of as a legging into an iron condor to help you guys take that next step into a more complex option trade. And that's why we had it is we're just putting like trades on both sides of that. Okay. Let's see. I think I got everything. Let's see. Forgot his name. Used to use phrase. Look, let's see. Okay. Yeah. All right. Good. Now, so here's another thing I want to cover is technical question. What is a delta if expiry equals strike price? What is a delta if expiry equals? I'm not sure expiry equals strike price. Oh, if it's right at the money. If 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 I'm understanding your question right, expiry equals strike price. Expiry equals strike price. I'm not sure I'm understanding exactly what you're asking, but basically if it's at the money, it's going to be a 50-50. Your delta will be right around 50. Okay. No, maybe we're not calling these inverse. They're called education. Like I said, I could have closed these out, but I have to wait. I wanted to wait to teach you. All right. Now, here's another issue in the market right now. We've talked about this is that, hey, we're in the middle of earnings, an earnings season, right? There's a lot going on out there. Um, and so, how could I showed a search last week. I want to just come back and talk about, another scan. So let's look at this. And by the way, options expire at the money. What is the delta, 0 or 1? Well, here's the point here. So, okay, real quick. This is an interesting thing. So let's talk about a call. I think a lot of people understand the call better. Um, so if let's do this. Let me get rid of this. Okay. So if the stock is at, let's say, the stock's at $70. Okay. Whoops, don't want an and sign. We want a dollar sign on that, $70. Okay. Stocks, let's say so what would happen if we had actually, let's do this. That's our call strike. Call strike at $70. Now, if the stock price, so let's say stock, if the stock price is at $70.10, guess what's going to happen on that one? It's in the money, right? It's in the money by 10 cents. And at expiration, what's going to happen? Even though it's only 10 cents in the money at expiration, that delta is going to go to 1, right? It's going to go to 1. If the stock were to drop, though, and now the stock it drops all the way down to, all the way down to 69.98, then that call is out of the money because we have a 70, right? So it's out of the money. And then the delta has to go to 0. And so you can see it's got to move real quick one way or another. And that's where that gamma gets really big in order to help it move very quickly to one side or the other. So that's what happens with it. Hopefully that helps you out. All right. Let's go over and look at the scan. All right. So let's do this. I talked about a scan in this class before, and generally speaking, when I run a scan, I kind of test and see what's working or something. Generally speaking, for options, I like to just use something on the stock because typically speaking, we're looking at the stock for the technicals, and if I find a stock with high volume, and it tends to spill over into the option. So something that's heavily traded, lots of volume of stock will typically, not always, be that way on the option, and therefore it should have tighter bid-ask spreads, right? So what I want to do is let's check something out. We've scanned this before, having a minimum price of $60 and having a minimum volume of 2 million. And sometimes I'll play around with that. But there's other things we could do. So for instance, what some people might do is even to further try to narrow it down and get more, tight bid-ask spreads. One thing that we could do after we already have this basis, and that's pretty simple to plug in. Obviously, usually these are just two right here. I just selected last and volume and put in those figures. To add to that, I could go in and intersect with. And what I want to do is come down to the N through R, because what I'm looking for is P, because I'm looking for penny increment options. Now, this is a little bit of a misnomer because it kind of gives this impression that it's a penny wide, very, very tight bid-ask spread. And while you can still say pennies, sometimes it's 100 pennies. It can get a little bit bigger than we want, but still, it tends to say, okay, let's find something that's a little bit tighter, right? And you can see actually that really narrowed it down. This was, if I remove that, I don't want to clear the whole filter, but I don't know if you saw that, but it jumped a little bit tighter. So it was starting to narrow down the results. Now, the other thing though that we want to talk about is we got these earnings season going on. And so a lot of times, what I like to do is just go out, look at the chart, pull up like the short vertical watch list that I talked about, how that's being built, and start scanning through it and say, okay, is there something here? Is there something here? Is there something here? And what I tend to run into is earnings. Oh, this one doesn't have earnings. That one's okay. Earnings, 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 earnings. That one's okay. Earnings. And so probably more than 50% of them have earnings somewhere in the near future, right? And so it just makes it so we're scrolling through a lot of them. that just tend to have earnings coming up. So if we go back to scan, one thing we can do is do this none of the following. We're going to add a filter here. Okay. And what I want to do is come down here and select study. So everyone with me here, none of the following and study. And then come over here where it has this ADX crossover, and I want to get corporate actions. And obviously select earnings. Got that? Everyone good at this? So once I click on earnings, I can say has earnings. Now remember, this is kind of a kind of a negative, if you will. So it has none of the following, right? And so I'm going to say it has earnings anytime between now and the next, we'll say 35 days. We're going to say 30 days. 30 days, okay? So what it should do is eliminate any stocks that have earnings that are just around the corner. And we can do a scan for that, right? And let's see, how many did we show? 31 is our result. Okay, so what we can do there then is then take that, and a lot of these will still be the same stocks we have already in many of our watch lists, but it should kind of filter out the ones that we have earnings coming up on. And so I'm going to click on the pancakes. I'm going to save that as a watch list. I'm going to say short Verts, no earnings. And you can name it whatever you want, right? Earnings, ing, yes, okay. Save that. And then from there, what we can do, let's go over to the chart. I got this on red over right here. I have my watch list on red right here. And then I can go into short verticals and into personal and say short verts, no earnings, and click on that. Now, as I go through, ideally, I should not have no earnings there. I'm going to hit the scroll button, go down, no earnings there. Go next. Earnings is behind us. Earnings is a day ago, so it's behind us. Earnings is a day ago, it's behind us. Earnings is behind us. Earnings, you see what I'm saying? So now we kind of got the earnings this morning, but still it's behind us. And so it filters out some of those earnings. And so we don't have to sit there and go, okay, nope, 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 nope. Yeah, possibly, nope, 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 that kind of thing. So that's one way to do it. And by the way, I got to give a shout out to Cameron. One of the things he and I were talking about another filter, one that he likes, and I got to show you this. It's pretty good if you're looking for something bullish, is we can come up here to add a filter up at the top. And then from there, I'm going to go, I think it's study. Yep, go study. So I came up here, got stock, went study, and I'm going to come down here to price performance. And then from price performance, what I want to do, so everyone's following along, is near high lows. Okay, we got that? I'm going to go slow so we can get that. Near high lows. And then what this is going to say is this is looking at the last 252 days and saying, okay, let's look for a trade that is within 3% of its current high. And maybe we just make that like 5%, something like that. And what this will help it do is like if we have a overall bullish market, oh wow, that really filtered out a lot. I think we have to widen that out just a little bit. It'll tend to pick bullish stocks. Now I had quite a few more earlier. I wonder what, wait, do I have an ADX? Oh wait, do I have an ADX crossover here? I don't want that. Okay, there we go. And so if we look at a lot of these stocks down here, AFRM, MSTR, a lot of these should be moving up. Let's take a look. AFRM. Overall, they've been climbing. MSTR. Yep, starting to move up. I can put these in a watch list too. Oh no. There's Lulu. A lot of these, and I'm off that by 10%. It may have been a little bit wide, maybe a little bit wide. Let's change that back to about 5%. Let's just kind of tighten this up a little bit. All right. And like UAL, what we'll find is a lot of these will have been, gosh, we're getting a bit of a pullback right now, but a lot of these should be starting to move up and should be not too far from their highs. WDay, oops, and whatnot. So hopefully that will give you an idea of ways. Oh, that's interesting. Why is that one pulling back? I don't know why it's, did I get that right? Oh, you know what? Oh, you know what I did? Oh, shoot. I changed the wrong one. I added it to the wrong group. I gotta scroll. I gotta move this down. It moved up. I apologize. I need it up here. All the following is in none of the following. That's why I was like, why is that dropping down? So I want to go to study once again, come down, grab the study, price performance, near high lows, and let's leave it at 3%. Okay, WDC, STX. Let's try this. WDC. There we go. STX. There we go. That was it. It just, I apologize. It fell into the wrong one. MU, Marble, MRVO. MU. Yep, moving up, MRVL. And moving on up. And so that's one that we could use just to add a little filter. I apologize, I didn't realize it dropped in none of the following. But you can see how that actually works. When I put none of the following, it kind of inverted it, didn't it? And a way to invert it is we could also put it near the lows and do the same thing if we're looking for something bearish. And so I've spent a little bit more time than usual, but I wanted to go over just some ways to find, some vertical opportunities, right? Now, I was looking over some charts. I want to make sure we get something in on today's session. So let's take a look at a couple and see what we can do. There's something like this, like, PG has been sitting down here at a support level, just kind of hanging out. Kind of interesting. Now, it hasn't really rallied yet, but you can see it's been maintaining a support level, and we already have earnings over. So that's behind us. So that was, oh no, dividend. No, that's a dividend that it has, but looks like it should have everything's behind us on that. And so we're good to go besides the dividends. And so that could be a potential. Of course, this is the one that's already rallied, right? It's already taken off a bit. But let's see, there's that FCX. Let's see. I was looking. This one gapped down. I thought this was interesting. It gapped down on earnings, but it's actually starting to rally back up. And it does have some fairly significant support right in about this area. You can see these were some lows in here, kind of retest highs. There's where it gapped right there. So there is some support right here that could potentially bounce off of. So it might be a little bit aggressive. Maybe we could play something, bounce up off of that. Of course, we have something very similar to that. Netflix is kind of similar where it came down to a support level. Come on, let's scroll up. So we got to grab one of these and run with it. All right. But you can see this has been holding, right? This support has been holding. It's a fairly significant support, especially with the gaps it's had on Netflix. A gap up, ride back, retest, come up. Now there's a potential for it to possibly find some resistance right in here, but we're starting to see some of that momentum roll back over, right? Should we see what we can do? Let's just see if there's something available here on Netflix. And if I look at the days till expiration and seeing, okay, what are our possibilities? If we close this up, is we have, I like to look first at the typical monthly expirations because they tend to have the tightest bid-ask spreads. So let's just see if we go out to that. There's only 22 days, a little bit on the short side. Usually if I'm looking for 30 or 40 days, can get a little more juicy premium in there. But let's go with this, and then we're looking at maybe a 91. If we're looking at a delta around 30 to 40. So where would that 91 put us? Well, 91 would put us right about there. So maybe just a little bit above that support. Maybe let's see if we can get the 90, go a little bit below that support, give us a little bit more breathing room. Okay. So let's add a little more. Not 810 strikes. Let's try to do 10 strikes. In fact, let's do 14. So what if we go to 90? Let's try the 90. I'm going to hold down the control button. I'm going to try the 88. Generally speaking, oh, wow, that's really kind of backed off. Of course, it rallied. That was closer to 60 cents when I was when I was looking for the class earlier. Here's the nice thing about this, though. These stocks, look at the natural versus the mid. 2 cents. These are very tight bid-ask spreads that it's going to almost really help our position get filled, number one. And number two, enables to get out at a better price as well. Now, here's the deal. This is 50 about 50 cents, and sometimes we could even place that at 50 cents, see if we get filled. But basically, the risk on this trade, even at 48 cents, is going to be $2, the $2 wide strike, minus, so we'll take the $2 minus the 48 cents, and that's going to give us a risk of $1.52, right? And so 48 cents divided by the $1.52, you can almost do that in your head, is going to be right around 30%. So we got 31, almost 32%. And so it's actually still not bad if we're looking for like a 30% risk reward. And a couple good things about this is, we do have kind of a lower delta. We're not at like a 37, 39 delta. And we're looking at 22 days till expiration. So I think this is where it's not a one size fits all, because it depends on if we're getting more time, then yeah, I would get a little more premium, but with less time, less premium, but also, um, we're getting into that really, that data is going to start kicking in and really, working this trade quickly. So what we're going to do is run with this. And then again, I mentioned the risk was $152, and we're going to do $1,000 on this trade. Now, there's other ways we can also money manage too, because if our risk is 152, that's going to go into 1,000 6.5 times. So we could do 6 contracts. Well, do we have to do them all at this price? There we got 49 right there. Let's lock that. We don't, maybe we do 3 of them at this price and then put 3 at a little higher price if we wanted to do something like that. And, I don't have time to go into just setting this and setting another one, but you guys get the point that I could place this trade at this price and then send 3 more, maybe a little bit more, and then, see what feels. And that way I feel like I can at least get something in that's setting up, but I could also get a little bit more, wait out for a little bit more. There's just different ways to manage the risk than just go kind of in or not in, right? There are ways we can test the waters, but I'm gonna go ahead and move this all to 6 right now for our class. I'm gonna go ahead and hit confirm and send. Make sure we're not missing anything in red. So let's leave this up here for just a second, make sure we got it. So we're looking to make possibly about $300, risking about $900. And there we go. Yeah, we're good. Go ahead and send that off. And this one will probably feel immediately because that tighter bid ask spread, boom, there we go. Okay. So what we're going to do is come in here. When was the expiration of those 22 days? What does that put us at though? The May 15. Yeah, May 15. So let's draw our box on that. So we're going to take this, we're going to go to $90. We're going to come all the way down here about 90. And we need to be above this spot by May 15, right there. Right there is our window. So that's what we're looking for it to do. Be above this line by the time we get over here. So we'll keep an eye on that. All right, so we've covered an awful lot today, folks. We looked at the market. We talked about the impact the market has. We talked about the trades, the importance of managing those trades, the risks that come up as we get closer to expiration, how those Greeks can throw us off at times. Where we may look at that and say, hey, we're in a good spot, and then whammo. I just don't want anyone to get sideswiped. I just don't want anyone to get caught thinking, oh, wait, I had it. What happened? Right? So please use this as a learning opportunity. Understand what can happen, kind of behind the scenes to these potential paper trades. But and then we went through some searches, we ran some scans, and then place a trade. Man, we got a lot in. Thank you for joining me today. I sure appreciate you being here, and thank you for the comments. And by the way, continue comment in this class below, and also give us a like and a subscribe. It really helps with allowing us to continue to create these classes, put this education out there for you to consume. It goes a long way. So if you haven't subscribed, please subscribe, and please hit the like button. It does help us immensely. So thank you. You guys are the best. Thank you so much for joining me today. Have a good day and have a good week. And I'll look forward to seeing you all next week, same time, same place. Okay. All right. Thanks, Cameron, as well. We'll see you. Have a good one.